Hello, it's me, Sasank Pandey. I'm going to talk about time value money and bond valuation. Here, we will understand bond pricing and investment strategies. Time value of money (TVM) principle asserts that a dollar today is worth more than a dollar in future due to its earning potential. That means if you have 5 rupees for now, then you go back if you go into the future after 5 years, then that 5 rupees won't be 5 rupees itself, but it will be like 7 rupees or 8 rupees, depending upon the uh, interest rate or something else. Here we will discuss about how bond maturity affects bond pricing and how interest rate changes impact bond prices and investment strategies. Here we will compare two bonds, bond A and bond B. Bond A has 30 years to maturity and higher exposure to interest rate risks due to its longer duration, whereas bond B has 5 years to maturity and lower exposure to interest rate risks due to its shorter duration. Bond B trades at a higher price because it has less interest rate risk and offers more predictable returns. As we can see that longer time will increase the interest rate risk. So, what will be the impact if the interest rate changes? Rising interest rate generally cause bond prices to decrease as new bonds are issued with higher yields. Bond A will experience a significant price decline because its longer duration makes it more sensitive to interest rate changes, whereas Bond B will experience a smaller price decline due to its shorter duration and lower sensitivity due to interest rate change. So, longer duration bonds have more interest payments that are discounted at the new higher rates, reducing their present value more than the shorter duration bonds. So, percentage price change due to interest rate change. Duration is a measure of bond sensitivity to interest rate change. For example, if the initial interest rate is 5% and it increases to 6%, the bond prices will adjust accordingly. Bond A with a longer duration, it will see a price change of approximately minus 20%, whereas bond B with shorter duration will see a price change of approximately minus 4.5%. Here's one example. If bond A has maturity of 30 years, and then if we apply 5% of coupon rate and a duration of around 20 years, 1% increase in interest rates result in minus 20% price change. Bond B, if it has 5 years of maturity with 5% coupon rate and a duration of around 4.5 years, it will have 1% increase in interest rate, which will result in minus 4.5% price change. So it shows that the impact of interest rate changes on bonds will different maturities. Investment strategies during economic slowdown. What can be the anticipation done? If an slowdown is expected over the next 12 months, that is 1 year, interest rates are likely to decrease as the central banks attempt to stimulate the economy. So here we will have the strategy to invest in long-term bonds like bond A, as they will benefit more from falling interest rates due to their higher duration. Here, lower interest rates increase the prices of existing bonds, leading to the potential capital gains for investors in long-term bonds. So, from this, we can assess that on understanding the time value of money and bond valuation is essential for making informed investment decisions sensitivity, like long-term bonds like bond A are more sensitive to interest rate changes compared to short-term bonds like bond B. So we will make strategy accordingly. In anticipation of an economic slowdown and falling interest rates, investing in long-term bonds can be advantageous due to their potential for higher price appreciation. So these are my references, and thank you.